Let's get into the nitty-gritties of how your fixed income strategy should change, if at all, or what it should be, and what the thinking from the perspective of the bond market is after today's policy decision. I'm joined by Devang Shah, who is the co-head fixed income at Axis Mutual Fund. Thank you so much, Devang, for taking the time. As always, pleasure speaking with you. Give me your first thoughts. This is, if you can call it that, to the higher end of the spectrum of expectations, I think, in terms of the policy rate decision. But besides that, what were your overall thoughts in terms of the RBI's move today?
So I think, as you rightly highlighted, Alex, most of the market participants were individuals expecting a 40 to 60 basis of rate hikes. I think probably RB was also very similar to what RBI did today. 50 basis of rate hike was expected. A certain part of the market were also expecting probably some measures on the liquidity front, specifically more like a CRR hike again, back-to-back CRR hike, so that that could have spooked the market more. But because the RBI monetary policy was on expectations, I think the entire focus of capital market participants after the rate hike announcement was more on the forward guidance, as well as what do they do with the projections on growth and inflation. More importantly, inflation. I think what probably slightly has come as a surprise is that, yes, now RBI is also in cognizance with the fact, and most of the guys were expecting inflation expectation for the full year to be closer to 6.5. I think it is slightly higher than that. But looking at the near-term trajectory as well as the momentum of inflation, I think probably, yes, the inflation for the year might end up somewhere between 6.5 to 7%. Except for that, policy was very much as expected. So I would say slightly dovish as against market expectation on the liquidity actions, which is, I think, probably a certain section of the market was expecting CRR hikes, and slightly I would say negative from the front of that inflation projection has been slightly higher than what market was expecting. And then result, I think markets were happy today. Around 5 to 10 basis of, I think, rally started once the announcement was done, but probably during the day, with more and more analysis of inflation being slightly higher than expectation, I think most of the gains are given up, and probably we are close to marginally yields lower or flat for the day.
I was going to ask about that because you saw early on, immediately after the policy decision was announced, you had the 10-year benchmark government yield go to about 7.45, correct? And then it ended very close to the 7.5 mark. Just your thinking on this inflation number, was that really foremost in the thinking of bond market participants then? That 6.7% number, that very clearly is above the comfort zone of the Reserve Bank of India. And this is an admission more than anything else that monetary policy has not worked to keep inflation lower. And hopefully towards the end of the year, we might see that fall. But there's no guarantee of that, right?
Right. So I would say, and a couple of things. I think probably the uncertainty about all these war has come like an uncertainty. Okay, it was not an event which no one had foreseen. Secondly, to a certain extent, because of that, somewhere down the line, the Russia-Ukraine crisis had developed to a significant supply chain issue, plus a significant blow up in food and commodity articles. The prices for them have blown out of proportion. This would have been difficult to envisage for any central banker as well as any capital market participant. Now the point is coming back to how the projections look across. If you look across the momentum as well as the current numbers, I think the numbers are huge. You look at the last three prints, the average on inflation front is upwards of 7.25. I think probably the next couple of prints also will be above 7%, close to 8%. In fact, the August and September prints as per us, or September and October prints as per us, will touch close to 8%. On the inflation side, I think RBI, what RBI could have done, and they have done very smartly, is probably proactively start acting towards the inflation and probably start looking at the reversal measures. First, foremost, start reversing, get back to pre-COVID, and then probably look at where the inflation settles along. Because as highlighted, a large part of the inflation is also coming because of this uncertain Ukraine crisis. Once that gets settled out, probably you might start seeing inflation lower. So RBI doesn't want to go too hawkish at this point of time, but I think probably RBI is doing the right thing, a intermittent rate hike, a surprise intermittent rate hike, and then back to back, again adding another 50 basis of rate hike. I think somewhere down the line, RBI is very clear that yes, they want to go to pre-COVID very fast and probably look after that what is the view on inflation. the Q4 inflation, which currently is at around 5.8%, probably tells us that RBI in this year, in the next 12 months or so, even if they go a bit wrong, would be targeting a repo rate closer to 6 quarter band. From here on, probably we are already at 490. We are talking about another 100 odd basis of rate hikes over the next 9 months.
Okay, so let's talk about that in just a bit. I want to understand the trajectory because we've spoken about this in the past as well, and I think in a sense this is leading into what you have said in the past also about the development of the yield curve. But let's talk about the liquidity management, because there was also a measure on that, right? Or there's some thinking that you have with regard to what was announced in the policy in conjunction with what happened in the April policy. Could you explain where the liquidity situation currently stands? And we know that you're talking about a withdrawal of accommodative stance. What does that mean from the perspective of availability of liquidity? When do we see that reducing materially?
See, pre-COVID, we had spoken about this, that during COVID, sorry, not pre-COVID, during COVID, RBI had done lots, including all the efforts that they had with infusion of liquidity to capital markets. I think CRR cuts, rate cuts, LTROs, OMOs, GSAP, they ensured everything to, first of all, ensure the credit flow happens, and somewhere down the line, the liquidity in the system, banking system, continues to remain amply positive. Obviously, inflation has gone out of whack. The first thing to start handling was the liquidity withdrawal. Today, I think one of the deputy governors also spoke about it, that their liquidity withdrawal started somewhere from Jan 2021 when they spoke about normalization of the yield curve. Sorry, normalization of the liquidity. So the liquidity withdrawal has already started. As per us, they would probably go to neutral liquidity by March 2023. Currently, if you ask me what is the system liquidity, it will be upwards of around 5 trillion. This is how I'm talking about the durable liquidity. And what we believe so is that this liquidity will start withdrawing in formats of either they will use FX as a tool, which there will be intervention on the FX side. There will be normal cycle currency leakage, which generally in a year you see 2 to 3 trillion currency leakage minimum. Plus, you would also see some bit of liquidity measures like CRR hike in future to go back to neutral liquidity. So our view is that by March 2023, because they had said multiple years, and by March 23, you will complete 2 years plus, they will probably go to neutral liquidity from a banking system perspective.
Let's come to the strategy that one should employ at this juncture and whether or not it's possible, considering inflation is at 6.7%, to beat inflation at all. It may not be possible in the near term.
First of all, apologies. I had some infrastructure issues at our end. So on to coming back to your question, I think somewhere down the line, as I explained, a large part of the curve flattening is already behind us. And what we believe so at this moment is that if you look at the 1 year, 2 year, 3 year levels, okay, the 3 year corporate bonds have already reached around 7. So our expectation is on a medium term. We are talking about next 2 year, 3 year investment horizon. I think a large part of the rate hikes as well as the pain is behind us. Investors who are looking at allocation for medium term should start looking at target maturity funds of 3 year, 4 year band, or short-term funds, which is typically now running 2 year, 3 year corporate bond philosophies. I think looks like a good option and avenues for us from fixed income perspective at this moment.
Okay. We're going to have to draw the conversation to a close at that point, but I think we've had a fruitful conversation, Devang, today. We've talked about the context and we've talked about what strategy should be. Thank you so much for taking the time.
Thank you.